Hey everybody, we are a couple weeks into September right now, and the market's kind of been interesting lately, right? We've the market hit record highs not that long ago, and it's recently pulled back because of inflation expectations and interest rate cut expectations, things like that. So we wanted to take a minute and talk about a couple stocks that are on our radar right now, and these are stocks that we don't already own, at least in my case. I don't think Tyler owns his yet. So before we dive in, please take a minute and check the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now from the Motley Fool. It's the best way to support this work we're doing on YouTube. Again, fool.com/Frankel. So I'll kick it to Tyler first. Tyler's looking at a company that I'm really familiar with on a product level, but not necessarily on a business level. So Tyler, what are you looking at right now?
So yeah, I'm looking at Interactive Brokers. The ticker is IBKR. I actually got that in there instead of forgetting this time. But Interactive Brokers is a online only prime brokerage for trading. I think for most you and I individual investors, retail investors, whatever you want to call us, we tend to go towards discount brokers. So your Fidelities, your Charles Schwabs, your Robinhoods, whatever financial platform you want to go to that does free trades. This isn't really a company that is catering to you. This is a company that's a little bit more built for institutional money, people who may or may not may need a little bit more than what a discount brokerage can provide. A big thing that, for example, 81% of its clients are actually internationally, because so they're pretty good at like after hours and trading. So people that or institutions who are making trades internationally can tend to do better with a company like Interactive Brokers. At the same time, like I said, internationally, I think 56% of the held equity of its business is actually from institutional money. So companies like this, they're looking to do things like bonds, foreign exchange trading, crypto, international stocks, and doing it in a way where the cost of doing these things is much cheaper. And also using margin loans. Just to give an example here, I think that Interactive Brokers trades has a very, very low margin rate for it. It's for people who get approved to make foreign exchange bets, which tend to use a lot of leverage, things like that. Or if you want, I don't know, let's go back to August. If you'd want to run a yen carry trade, the fancy term that I've been using for interest rate arbitrage, their interest rates are considerably lower than the margin rates at a lot of like the prime brokerages like JP Morgan or places like that. And so as a result, it tends to attract a certain client base relative to, maybe really, really large institutions. They kind of specialize in that mid-market, managing of several $100 million, but not necessarily like tens of billions or hundreds of billions. As an investment, I think one of the things that makes it look attractive, number one, is a lot of inside ownership. The founder owns about 75% of the company. It's relatively high margin. It gets about 71% margins, or operating margins, relative to, when we look at discount brokerages, they're really, really low margin business. So seeing high margins, high insider ownership, there's a lot to like about this business in terms of the bones and the profitability. And at the same time, it's trading for about 19 times earnings, which is relatively cheap speaking for businesses that are growing at the rate that it is. Obviously, the downsides for businesses like this is kind of trading volume, or basically how much interaction or participation is going on in the markets at any given moment, which makes things lumpy. Which I don't know, for a lot of people who are looking for those quote unquote quality compounders that just go up all the time, that might necessarily be the case with Interactive Brokers because of, like I said, lumpiness in its trading revenue. But overall, it's a business that's taking market share. It has high margins, and there's just a lot to like about the bones of it. And for the price that it's trading at, I think that's pretty good.
So I'm going to go in a little bit of a different direction. You're not an Interactive Brokers customer, are you?
No, I've threatened because I feel like I'm starting to look at international stocks more, which are a little bit harder to
That's
do on
true.
discounts like Fidelity. But no, I haven't made that full on transition to interactive
I,
brokers yet.
and yeah, and I that's exactly why I brought it up, because I did the Interactive Brokers product review for the Motley Fool's sister site, The Ascent, and as well as their best places to buy international stocks list, and it's not even close. Like there are a few others where you can buy international stocks, like Schwab's one of them, where you can trade directly on international markets. E-Trade actually exited that business a few years ago because it's very hard. And interactive brokers, they're 10 times better than anyone else in international stocks.
For what it's worth, I have Fidelity. I can get international stocks. I just find that actually finding them on their platform is pretty hard.
Yeah, and interactive brokers makes it easier than most too. It's not just that it's accessible and affordable. It's easier. So I'm going to go a different way, but another financial sector stock. It's Capital One. I've talked about bank stocks quite a bit on these recordings. We just did a video on Bank of America. I've also talked about companies like Wells Fargo, Ally Financial. I talk about SoFi if I want Tyler to roll his eyes at me. And Capital One's somewhat of a different one for me. It's one that I don't own yet. It's another stock that Warren Buffett's been selling. And I totally disagree with him on this one. Um, so this is a play that if you are worried we're going to enter a deep recession, you should avoid. If you think the economy is going to be fine for the time being, or at least like somewhat resilient, then Capital One looks really, really interesting right now. A lot of people know Capital One best for its credit card business, which for good reason. It's one of the biggest credit card issuers in the world. A lot of people don't realize it's also a branch based bank with hundreds of branches. I didn't know that until the first time I went to DC, because that's where they're based. They're pretty much that's where the name comes from, Capital One. Um, so they are a branch based bank. They kind of combine a lot of branch based and online banking practices. Like they focus on online high yield savings accounts, for example. So it's helped them really build their deposit base more than a very localized regional bank would. Um, and it's allowed them to grow their credit card portfolio in a more economical way because now you have a low cost deposit base. Um, so the really kind of interesting thing about the credit card business, people worry about in a recession, and for good reason, because the default rate can go up significantly. Right now, it's Capital One's default rate's about 6%, and that's not that high historically. In a deep recession like financial crisis, it's really easy for that to creep into the double digits. But the credit card business is a high interest form of lending by nature. The average credit card interest rate, even if you include things like 0% promotional offers and things like that, right now is about 21%. So Capital One's deposit cost is in the 4 to 5% range. Um, and even if you include like a reasonable like 6% default rate, there's still quite a bit of margin there. Capital One has a 6.7% net interest margin. That's roughly almost triple what Bank of America has right now. Um, and it's about double what most big banks would be very happy with. And so it's a very, very profitable business. There's a lot of cash and reserves to cover even a reasonable uptick in that default rate. I want to say they have just under 9% of their current credit card balances in reserves just in case things get a little bit worse. The net charge off rate has stabilized over the past few quarters. There was some worry that it would keep ticking upward as we came out of the pandemic. That didn't really happen. It really has stabilized at around that 6% level. Um, so Capital One, I like him for two big reasons right now. One, because I think unlike banks like Bank of America, I think Capital One could be a big beneficiary of lower interest rates. They have that high deposit cost. They give savings depositors 4 to 5% interest. For example, they offer CDs that have over 4% interest right now. Interest rates coming down would directly lower their deposit cost. It would be a very nice margin tailwind. And they're also planning to acquire Discover, which has a lot of interesting implications. First of all, Discover, it might sound like they're acquiring a direct competitor. They're really not. Discover's credit card products and Capital One's own credit card products are very complementary to each other in a lot of ways. They both offer a lot of things that the other doesn't have. Discover is well known for its, just for example, its 5% cashback rotating category credit cards. Capital One doesn't have a product that really is comparable to that right now. Capital One offers a high-end travel credit card product, the Venture X card. Discover doesn't have a parallel to that. So it's a very complementary business, for one. And number two, the acquisition of Discover will make Capital One the only mainstream bank. I don't count American Express as a mainstream bank. They don't have a big branch network to own its own payment network. That creates a lot of really interesting cost saving abilities. Right now, Capital One credit cards have a Visa or MasterCard logo on them. If it owns its own payment network, it could have it, bring those onto Discover's network gradually, and then avoid paying those kind of interchange fees to Visa and keep those in its own pocket instead. And it could also become a third-party issuer of credit cards if it owns its own payment network, kind of like Visa and MasterCard are right now, and American Express is to some degree. Wells Fargo has an American Express, processed credit card product, for example. So it creates a lot of interesting long-term growth possibilities. The stock trades for about 12% below its recent highs. There's been a pullback. J.P. Morgan kind of scared the industry when it said that its current estimates for interest income are too high. So that kind of sent all bank stocks lower. And Capital One in particular trades for 10% below its book value right now, presumably because of the recession-prone nature of it, the credit card business. So again, if you think that the economy is generally going to be fine, which I'm of that mindset, then Capital One looks like a very interesting investment right now. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from the popular product Stock Advisor. Stock Advisor has beaten the market by nearly 5 times. So go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 767% as of July 5th, 2024, and are measured against the S&P 500 returns of 163% as of July 5th, 2024.